Good evening and welcome everyone. My name is Philippe Schelligen. I'm from Boost Capital Group. Our company helps busy professionals invest passively in real estate, particularly and mostly in in-place multifamily real estate with value-add business plan. And so we're hosting Real Estate Accredited. It's a multifamily real estate virtual meetup where we share some educations and we want to make it live and interactive. So feel free to ask any questions at any time. And my co-host and partner, Jeff, is not with us tonight. He had another commitment. I will take care of the presentation. And so just be patient. If you ask a question in the chat, you can, or just the best is just to unmute yourself and ask. But otherwise, we can do the Q&A at the end, and you can write some things in the chat, and we'll cover that at the end. So our topic today, we're still looking at the acquisition process. We started 2 or 3 weeks ago. And actually, I'm going to go over what we covered so far. But today particularly, we're going to talk about the capital raise and closing. And again, focus is on in-place commercial multifamily with a value-add strategy, and that being made in a syndication, meaning that we pool investors' money together to buy large properties. All right. So we've used that timeline several times so far. I think it gives a good overview of the big picture. And from an active investor view, as well as passive investor view at the top. From active investor view, and what we've covered so far is the deal finding, underwriting, and how to make offers or write a letter of intent, LOIs. Now, we are in the middle, or rather the second major part of the acquisition. That's what we'll cover today. And I'll go a little more in details in a sec. Otherwise, after the acquisition, you always have the execution of the business plan, which is typically doing renovations to units and also what is called stabilization. Sometimes if you have your occupancy that's a little bit low, below 90%, there could be a stabilization as well. There will be then an optional refinance, and then at the end of the whole, disposition and shut down from an active investor point of view. But the passive investor, they will be aware of the deal before it closes, and then obviously during the whole period. So if we take a magnifying glass on the acquisition timeline, and that those are things we discussed, topics we covered in the past few weeks. And by the way, I will share we post all the recordings on our YouTube channel. So if you want to watch past discussions, you can on our YouTube channel. And don't forget to like and subscribe. So we covered the underwriting, the LOI, preparing an LOI. We covered the contract negotiations and signing the contract, as well as due diligence. And finally, the go, no go. So those are all things we covered so far. Today, we're going to talk about, again, capital raise and lender process, which typically takes about 60 days. And it takes place after, obviously, you signed the PSA and after you've done the due diligence and decided to go ahead with the acquisition. Okay, I'm going to skip. We covered the other things in other discussions just for illustration purpose here. So let's jump in again as what we've covered so far: underwriting, offer, contract, and due diligence. Repeating myself here. So first, let's think about the capital raise. And it's not something we've discussed until now, but it's really something you have to start as early as possible. And the idea here is to gauge how much interest there is in a deal Usually, you're going to update your potential investors throughout the process and basically give them a heads up. By the way, we found this deal. We started to look at it and we worked the deal or anything. We underwrote the deal. It looks great, etc. Give them a heads up. Once around the time frame you get right before, and I would say actually right after your LOI is accepted, I would start sending a teaser. And a teaser is really like a one-page summary. I put an example here. It's like very brief, give some high information, high level information about the property, the market, and what's your business plan with the two sentences and what are the returns expected, as well as the timeline on one page. And that's where you want to follow up with people, ask them to give you feedback. You have to be aware of, and like I wrote here, you have to gauge interest. If people are saying, oh yeah, I'm interested, keep me posted, you're on the right track. But that's how you don't want them at this point to soft commit, but you just want them to express interest into that particular deal. And my third point here, you would probably at that stage have a good idea of what's your capacity to raise, right? Something when I talk to students about multifamily acquisitions, something you need to have a good idea as early as possible. And so engage general conversations about raising money on multifamily deals as early as you can. As soon as you start really getting interested into multifamily, I would start these conversations to really educate any potential investors that you have in your network and also may just make them comfortable with what you're doing. So eventually, when you have such a deal, when you are in that situation, they'll be in a position to invest. So if you, and it's often the case actually, but if you cannot raise the whole amount, the whole equity for the deal, you're going to start also talking to additional partners about raising on that particular deal. So you're going to make your team a little bit larger and bring help to help you raise on that on the deal. So some tips, if you bring partners, it's good practice to have them financially commit to a successful raise to close the deal, meaning that you're going to ask them to participate maybe to the earnest money deposit that you're going to have on the deal, and to make sure that everybody is committed at the same level to closing the deal. Because you don't want necessarily like the lead sponsor or the lead person to be on the hook for all the earnest money. You have to have all the partners equally invested into the deal for a successful close. So my second tip is by the end of due diligence, which was right before this, the phase we're covering today, you want to have a very good idea of where to find between 2 and 3 times the capital that you'll need to close. And I would say, especially if your first deal, you probably want to go to be closer to 2. If you're doing deals on a regular basis, maybe 1.5 is going to be sufficient. But you want to have more than enough money or enough interest at that stage. But it would be like early interest. Again, you're not asking soft commit, but early interest to be able to close. So you have high confidence that you'll be able to close. And then when you take the decision to go or not to go with closing on that particular deal, you'll be comfortable. That's, I think the reality of this, it's a little bit ideal and it's pretty challenging. I would say you have to use your common sense, talk with the different partners, and make sure everybody is on the same page to and have the confidence to be able to close on the deal and raise the funds. My third tip here is do not rely on one single big check investor or along the same lines, a pref equity partner. we will come with a big check. So actually, just last week, I was talking with a student. I think he had probably 60 or 70% of the equity that came from a single investor. And things happen. Sometimes it's like you cannot control that single investor and or that pref equity partner. So if you have big checks, you 100% need backups, a backup solution to be able to close. It's very important. Don't rely on a single source. It's because it's risky. If there are no questions, I will go to the next slide. Now we are more specifically talking about the capital raise, but after you decided to go no go on the property, on closing on the property, those are the typical steps. You're going to prepare an investor presentation, and I have a whole video actually that I made, and I'm going to look for the link to it, and I will post it in the chat if you're interested. Okay. On putting such a presentation together. All right, so that's the link. It's in the chat. So you're going to cover many topics, talk about the property market, submarket, why those markets and submarkets are good, your business plan, the investor returns, the team, etc., etc. You'll see if you're interested, you watch the video. It's going to be, I think I cover like 16 different topics, and including also like the any sensitivity analysis to see if occupancy is going to change, what's the effect on, for instance, on the returns. Once you have this investor presentation, you're going to schedule a webinar. And the idea is to do like what we do today. You're going to go through that presentation that you put together and then answers investor questions. Some people do prefer to do a pre-recorded session and then answer the questions separately. I think it's a factor of is depends on your investors what you prefer, what they prefer to do, and also I think I like to do the pre-recording because then I can have individual discussions with investors and answer their questions individually. And when we have multiple people involved, presentation also sometimes it's a little bit challenging to bring everybody together. So have a webinar and also do email and text message campaign to your investor list. Usually we send 3 to 5 messages and emails on any given raise that we're taking care of. And number 4, have the individual calls, as I mentioned earlier. And also what I recommend doing is to prepare a Q&A, like the typical questions that are coming often. I must have a template somewhere. Those are things you should be prepared to answer. And obviously, by going through the exercise and all the steps you've done so far, you'll be well equipped to answer any questions on the deal at that point. Tips: you have to do things according to the SEC rules. So if you're doing a 506B offering, it means that you have to have a pre-existing relationship with to qualify the recipients to whom you're going to send information. So that's very important. See, it's not the same. You can advertise actually, but 506B is very important to have this pre-existing relationship and basically know them for a little bit of time. There are other requirements, but that's it in a nutshell. And another tip, you want to make the investment process easy for investors. So that's where having a portal is really helpful because usually it streamlines all the steps. I like Syndication Pro. It's fairly straightforward. It's not the only one. I want to list all of them. There are a lot of choices out there. I think it's very common these days to have a syndication portal. When I started in 2017, actually, we didn't have a portal. So it was a different time. for sure. But we started to get one, I think, the following year, pretty much. So let's switch to the lender process. And if you remember, during usually as soon as you have maybe not necessarily at the last day of the due diligence, but when you know that 90% plus you're going to proceed with this acquisition, you're going to submit a loan application. And here I'm showing Fannie and Freddie, which are the larger lenders and what's called agency debt. Typically, the better terms, the better interest rates that you're going to obtain. And those are applicable for stable properties. So what they're going to ask, information about the property, as well as the underwriting, and that's probably information that you started to provide prior to that point, but it's going to be like a more formal submission really along with the loan application. And what you didn't provide necessarily yet is for all the managers and also called in that case key principals, people signing the loan, you're going to have to provide personal financial statements, schedule of real estate owned. You're going to fill a bad actor questionnaire. And also, you'll have to provide your social security number because they will pull a credit report. So that's all part of the application steps. You will pay an application fee. I think it's probably between $5,000 and $10,000. A good part of these fees are for the appraisal and the different inspections. So the lender, on your behalf, they're going to order an appraisal. They will do also a physical inspection and environmental inspection. And that's going to be the lengthy part, right? About the 60 days process. So that's going to be probably 30 days, that section here, the number 3, the appraisal and inspections, because they have to schedule those tasks to be done, and that takes a little bit of time. Usually, probably additional paperwork. There's always additional information needed, but eventually they will provide a loan commitment. And there's also something I didn't write down, but at some point they will lock the rate. So I believe there's a rate lock that is going to come closely after the appraisal and the inspections. And then the final paperwork, the loan commitment. And about a week before closing, they will ask you to pay them, but something that will come back to you. But you have to do a good faith deposit. And because that's when they start to allocate the funds and get the funds ready to for the actual closing. And the good faith deposit is just you're committing additional money to closing, actually. That's the role of that amount of money. And again, that's something you're going to get back at closing. And finally, you're going to close. They will provide the money to the seller, the agreed upon money, and pay for the different things that are in the closing statement. But something I'll mention a little bit more in a minute. Tips, yeah, something not to forget. There is a requirement from the lender that 5 to 10% of the down payment must come from the KPs, the key principals or managers. So that's something to take into account when you are going to come to the closing. And so that's money. And usually they don't want to see, for instance, the acquisition fee. So it has to be like fresh money. But something to be aware of. Now, the legal process, and I will answer the questions later on. I see we have a few. So from a legal standpoint, so after the due diligence And so now you're on the path, basically, like to closing. There will be a number of iterations between the seller, buyer, and lender's attorneys. You'll be in the loop. They will keep you posted. And you just, I think, unless they ask you directly a question, but you just want to make sure things are going smoothly, that nobody is procrastinating or something like that, or they're not stuck on something. Just monitor everything. And yeah, be prepared to answer last minute questions, provide additional information. Usually, it's the type of thing, time is of the essence. So it's a little bit stressful. But yeah, that's this part is part of the process. After these iterations, and assuming everything is going correctly, be prepared to sign a lot of documents, and that's for all the managers, all the KPs. They will have to sign a lot of documents. Finally, or almost finally, check the closing statement. So it's all the money going in and out. Like when you purchase a single family, always good. Like somebody has to check that statement. There could be some mistakes. And finally, the legal or your lawyer will let you know the transaction is formally closed. One thing that is always good, I think, is you want to have a little bit of flexibility on the closing date, especially if it's getting close to the contract time frame. You want to have extension provisions in your contract up front. So that's the best. So at least you may have 15 days or more provisions. So it's very smooth process. Just have your lawyer to say, oh, we're going to have to apply this provision. Because if there is no provision, then it becomes a negotiation. And if you're getting close to the end of the contractual end of the contract, it's the contractual end of the period of time you're under contract for, the seller could say, you didn't fulfill your obligations before the due date, I'm out. And that's especially problematic if they have another buyer who is pushing and we can close the deal quickly and so on at a higher price. So yeah, have extension provisions in the contract up front. Sorry. Post-close actions, by that time, you will have your property manager ready to take possession of the property on your behalf. It's just a matter of coordinating with them. I'm sure they will be well aware by then, but another element to coordinate. Then when it's done, notify your investors. I showed an example here on the right of a recent closing we did last December. And last step, you can distribute the acquisition fee to managers, to the different managers. And it's time to celebrate. All right. And that's all I have for tonight. So I'll go over the questions. Feel free to ask. I see. Okay, there's an AI snuck in. What's the name of our YouTube channel? I think it's Boost Capital Group. Yeah.
I found a competitor, Philippe, and I almost clicked on the wrong one.
Really?
Yeah, so maybe it's just me. So I took the link that you listed, and it went right to it.
Yeah, actually, that's the name of the channel.
And I
Yeah, actually,
subscribed.
I have it here. YouTube at Boost My Capital.
Thank you.
Yeah. What happens if one of the GPs passes away after the close? There should be provisions in the operating agreement to take into account that situation. Yeah, it's in the company agreement.
Thank you.
Absolutely. An example of the bad actor questionnaire. I think you'll see the bad actor questionnaire in any PPM, actually. It's the typical thing. I can take a look.
I've never heard of that, but I've heard of provisions in a company agreement for bad actors, but I've never heard of a questionnaire.
Yeah, there
Does it
is a
accept?
Let's see if I can find it. Otherwise, yeah, it's part of the loan application process. Let's
Hmm.
see. Loan pre-close. Yeah, I will have to dig. I will have to
Yeah.
dig.
Oh, no worries.
I
Thank
think
you.
for me, it's in the loan application, but I don't have an example at hand. Yeah. It's going to be like, did you have bankruptcy? Did you go in jail to jail? Have you? Is there any legal? Which is it's not really bad actor in that case, but it's like any you have any legal actions ongoing? Are you being sued or something? So you have to give an explanation
You mean for the business or for the person?
for the person.
Oh,
Yeah.
yeah. Well, Tesla took out my shoulder and I can't get them to pay for medical
Yeah, but
treatment,
and
so I
that's
was in
fine. You say
trouble.
yes. Yeah, you explain. You have to explain. Yeah,
Hmm.
yeah. Is there an instance where lender might ask you to deposit more than 10,000?
Can
I
can they
guess,
can they
are you
absorb it, or
talking
are they
about
going to
the
make you do it
application
before you close? That's my question.
or before the good? Are you talking about the good faith deposit or the application fee?
The inspections, because if your unit is closer to a place where they use solvents and they need more than the phase one, are they
Yeah.
going to come back before you close and ask you for more money if it costs more for environmental, or are they going to
The,
make you do
the,
that at
the
close?
fee is going to cover the basic, I think is going to take that into account. Now, if you need something else, it's probably that's a good question actually. But
Just
I
trying to
would
be
say probably at
prepared so
closing.
that I
Yeah,
wouldn't let anyone down if I didn't do enough due diligence to know that they're going to ask for a certain type of environmental study
yeah, but
if we're next to a dry
yeah,
cleaner or something.
that's part of the fee. They will have that covered in the fee. Yeah,
Okay.
yeah. It's going to be the thing up front. And I know, for instance, the fee will cover some legal, not everything, and they're going to get a little bit. And actually, maybe their lawyer will charge you separately, actually, at closing. Yeah.
I had a question. It's not about the syndication or projects as large as what you were referring to in your PowerPoint. I had a question in regards to acquiring loans, maybe more so your opinion about it. So you're going to purchase something that's maybe only 10 units, a very small project, and you're doing it yourself. You have your LLC, maybe even your Dun and Brad number, things like that. I was thinking that I could, in addition to securing a credit card, a line of credit in the business's name, but to go out and seek a loan, a business loan that may, I don't know, be $20,000, $30,000, of which I would use that money, the borrowed money, to make the payments every month on the loan, but have the money in the account so that should myself working this deal on my own, once the property is acquired and the first tenant moves out, I can go ahead and elect not to renew that lease and then use some of that money for a proper rehab. Is that
Yeah.
feasible? How do you feel about that?
So I think if you'll be, yeah, that's an interesting, actually, that's an interesting, there's nothing, if you create an LLC that is going to be the legal entity for the asset
Yeah,
and the
yeah.
business, and let's say independently of doing your loan and so on, can you get a credit card for that particular business? I don't see why not. I don't see why not. I got credit cards for my own business, though it's not. Yeah, it's just I'm doing different. Yeah, I do hold some real estate and I do other activities in that.
Yeah. So
So I
I've,
guess
I've done it before, right? I've had
yeah,
a business, it was a car hauling business, and I do still own that credit card in that car hauling business's name, that LLC. But so I know that I can do that portion, but the other component was to be able to get a loan that I would, because my thought is the loan would have a lower interest than the credit card. I do understand that
Of
the
course.
benefit of the credit card is there's no payments if I'm not using the credit card.
So in that case, are you talking about it's a brand new LLC you in your
Yes,
scenario?
yes, and this
Yeah.
one would be specifically for the real estate. And yes, I'd have the credit card. You can
Yeah.
use the credit card, and the beauty of it is no payments if you're not using it.
Right.
But my thought was, could I secure a actual loan
Yeah,
where I
of
could?
course, you buy when you do, and as you probably know, it's like the residential, it's 1 to 4 units. And when you look at a residential real estate, they're going to look at you and your credit report and your income, et cetera, to make sure that you'll be
This is a DSCR loan that I'm
right.
getting.
Exactly. So above, once you go 5 plus, yeah, there you go. So it's a DSCR loan. So now it will be based on the underwriting of the property, and you're not going to be able to do an agency loan because it's going to be $1 million minimum. Depends on the price per unit that you're looking at. But if you have $1 million minimum, then you can get a loan from Fannie Mae or Freddie Mac. Otherwise, you'll have to go to a local bank to do a loan. Now, the difference at that point, Fannie and Freddie, they're doing non-recourse, whereas a local lender, it will be most likely a recourse loan, but meaning that you are personally on the hook if there is a default. That's the recourse portion. But otherwise, like you said, it's going to be a DSCR loan. So okay, you're underwriting the asset. This is what can be done, and they're going to lend you based on this number.
Okay. And so just to be clear, the loan would only be sought after the property was acquired. The DSCR loan would be used to acquire the property, but the loan that I'm talking about trying to get a quote unquote business loan, maybe for $10,000, $20,000 to just have that money sitting in the account as that extra cushion on top of any cash that I may have, just trying to mitigate using all my cash, would be acquired after the multifamily.
Okay. So you're not talking about the acquisition piece.
No,
you're talking about just financing your renovations.
Yeah.
Yeah, that's going to be, and that's something, I mean, depending on the land, I would probably try to negotiate that upfront with the lender.
Okay.
Before you close, because I don't think you can, because I know you can, I'm pretty sure you cannot do an SBA loan, small business type of loan, because like you need employees, or I know it doesn't work for real estate. I'm pretty sure.
Okay.
Yeah, I think it's if you work with a local bank, that's something I would discuss with them to have some kind of line of credit.
Okay. Yeah.
At the top, because I know in some cases, Fannie and Freddie, they are doing some construction loans, and I guess the other option, let's say, you can always do some kind of bridge type of debt, right? Which is basically, I think, the equivalent to single family is like a hard money lender, pretty much. So now you'll be able to borrow in that case the money for the acquisition as well as money for the renovations. But I think the downside of that is going to be higher interest rates.
Yeah, so that's why I was thinking it might be better to get it separate, but okay.
Yeah, and I guess if you get a separate thing, and like you said, it's a DSCR loan, and let's say you're talking to the lender, they're going to look at the total debt right? Like to look at the DSCR. So it's a catch-22. It's like maybe you'll have to put more down payment to fulfill the requirements to be able to borrow money. So then why not using that money in that case
Okay.
to pay for the renovations? Yeah, that's all I can think about right
Okay.
now. Oh, you're welcome. Thank you for joining the call. Let's see if there are any other questions. Fresh money. Oh, there you go. That's the fresh money. It's right here. Yeah, fresh money is not money that like you like your acquisition fee. They want fresh money from the outside. That's what I meant by fresh money. Paula. Any debt owed might be depending on credit overall. I'm not sure about what you mean. Like any debt owed might be.
Yeah, I think that was before I knew that
Oh,
Leslie
for
was talking about
Leslie's question.
after
Okay,
her
okay,
property
okay.
was acquired,
Yeah.
and SBA is going to track everything and make sure you have enough raised. So that answered the question. Thank you, both of you.
All right. Any other questions?
Question
To
we
everyone
have
for
is,
joining. Appreciate it.
no, we
Ah.
got it. We just didn't know what fresh money meant. That was
Yeah,
all.
so in other words, you don't want us to take, they will not let you have the money that you allocated for your acquisition fee as any
Correct.
part
Yeah.
of that other application fee.
But yeah, and as a matter of fact, if you do quick math on where is it now? On this, if you and usually you're able to negotiate it like at 6%. I forgot. There's if you do a 3% acquisition fee on the total acquisition and you're borrowing, you're doing a leverage at 20%.
I would think it'd be
Basically,
higher.
the requirement from the lender and your acquisition fee is the same amount. And the acquisition fee is equal to the acquisition fee. I forgot. I did the math at some point and I cannot think about it. But it happens to be the same thing. And by the way, it's all the KPs together. So you can imagine to bring a dedicated manager who will take care of this particular payment. For instance, if like you're a little bit short on liquidity. Or at the end of the day, it's you leave your acquisition fee in the deal. All right. Is there any other question?
No, Philippe, that was great. Thank you.
Thank
Oh,
you.
you're welcome.
I like your slides. I subscribed. Yes,
Thank you.
you're welcome.
Subscribe to our channel.
That's
We're
right. I
trying
like
to
it.
get
It's
traction.
good. Give
It's
you the
much
thumbs up.
appreciated. I
Good,
see
it's good.
people
All right.
starting to, yeah. So again, thank you. We're going to wrap it up. If there are no other questions, thank you everyone for joining.
Thank
I
you.
see we have left Faray, Leslie, Carl, and the dynamic duo,
Don't forget Adriana. She's
Paula
so
and Adriana. And thank you for joining us this Thursday evening, and we'll see you next week.